Two Bulls in a China Shop is brought to you in part by our sponsors and friends over at Manscaped, Trade Pro Academy, and Vanta Trading. Manscaped is the best in men's below-the-waist grooming with precision-engineered tools for your family jewels, and with a new and improved 2.0 version of the Weed Whacker now available, it's the perfect time to take advantage of our exclusive offer of 20% off and free worldwide shipping using promo code 2bulls at manscaped.com. As always, that is the number 2. And when it comes to institutional quality trading education, look no further than tradeproacademy.com. In our free Discord server, you'll find instructions to take advantage of our discount with them as well. And for anyone trading futures, check out vantatrading.com. Founded by Mr. W. Banks and Baba Yaga, they provide a ton of educational content with the focus of teaching aspiring traders how to build a repeatable, profitable process. Our exclusive discount code for Vanta can also be found in our free Discord server. We'll have all of those links and more in the episode description. Thank you for listening, and I hope you enjoyed today's conversation.
Welcome to BreezeLine, where you'll say ta-ta T-Mobile, because we have 99.9% network reliability, and they don't. That's right. Time, weather, or even streaming in a basement won't affect our superior service. That's because we have real internet, backed by our fiber-powered network. And T-Mobile, well, they just have a 5G cellular network. So for a limited time, find your perfect speed with prices starting at $19.99 a month for 24 months. Terms and conditions apply. Go to breezeline.com to learn more.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from two idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat, smiley face.
Hello, everybody, and welcome to the China Shop. I am your host, Kyle, and joining me for today's roundtable is a pair of Eriks. We have economist Erik Mason and Erik Smolinski of ES Invests. I know that might get a little confusing, guys, but so to avoid any of that, what I'm going to do is I'm just going to stress the different spellings between the two different names. So when I say Erik with a K, then you know that I'm talking to Erik Smolinski. When I say Erik with a C, then you know I'm talking to Erik Mason. That should take care of everything, right?
If you would like, you can refer to me as Mason if that makes it easier. It's half my life I've been called that. And I got two first names.
And I was just gonna say, anyways, for you could always just call me Daddy, and that's fine too.
What is that not different enough? You guys can't hear the K? I mean, as some my name's spelled Kyle. I get pissed when people call me Kyle. You know what I mean? No, too much. All right. Well, since we just pre-recorded our normal little before we dive into things, we can just jump right into today's discussion. I think we wanted to kick things off with a question from White Boy Rick, which I think you noted was your favorite name here.
It's by far my favorite name.
Since this should kind of key in our flavor, basically, all your responses. So, are you Keynesian neoclassical or new Keynesian, and what does any of that mean?
All right, so unfortunately, I'm none of those things. I'm what you call an Austrian.
So I thought you'd said that many times.
Yeah, I'm very open about my love of Austrianism. So, what an Austrian means is that we believe. So, it's founded by Friedrich Hayek, who was a contemporary of John Maynard Keynes. So what Austrianism is it has really two definitions. One is kind of your classical definition is that I believe that prices matter and interest rates matter, that any effort to distort market prices or to distort interest rates, regardless of intentions, lead to a more inefficient economy. So it's very important to preserve prices. Prices solve problems because prices relay information efficiently.
Mm-hmm.
Now, what it means from a practical sense is I believe in the man on the spot. That, say, for example, somebody goes and buys a car. That individual buying a car knows more about his individual economy than all the great economists in the world combined together. That no matter how much education I have, how much education the thousands of economists who are smarter than me have, that we don't know the individual better than the individual knows himself. And if you take all those individual transactions from buying a car to shopping for groceries to picking a job, and you sum all those together, what you get is the economy. So my belief is that we allow individuals to make decisions and we observe that, which is a real kind of wussy way to say, I don't believe in these massive macroeconomic trends and these pushes and pulls. Yeah, I'm just I like Austrianism because I hate to say it, but it's Occam's razor.
It sounds like the lazy economist way. I don't have to do any of that other work. We'll just let everybody else figure it out for
Yeah,
themselves.
I just don't think I'm smarter than anybody else. That's really what I come down to.
Yeah. No, I love it.
I have a question on that. How do you reconcile like irrational consumer behavior?
Mm.
Yeah, so that's one of those questions. So you get like, and I kind of like the discussion of irrationalism. Um, so one of the pillars of economics, we have several pillars, but like one of the three major pillars is people behave rationally, which is nonsense. It's people behave rationally given the information they know. So whenever, like, I actually use this even in my day to day life, which is like if me and somebody, myself and somebody else comes up with different ideas or conclusions, I always assume there's an asymmetry in information. A lot of the questions, like they'll come back to anything we discuss in economics, is I think everything's asymmetrical information. Um, and so
Ah.
you may have an irrational consumer that we view as irrational, that they view as rational, just because they may be perceiving the situation or the maximization of utility differently.
So they're making rational decisions, but their interpretation of the data is not necessarily correct, is what you're saying?
Yeah, like somebody could be making a decision they think's rational because they don't understand. Like people who buy essential oils could think they're making a rational decision
Mm-mm.
because they're not familiar with like science or any or just anything.
Well, I guess that to peel that layer back just one more step, one of the things I see in trading is it's not necessarily always an information gap, but sometimes we have an overarching preference that still overrides a known rational better decision, but we still pick the other one for whatever reason. Do you guys account for that in your view of economics as well, or no? Like, for example, you could have somebody with XYZ budget, and they know it makes more sense to buy something that's $5,000 cheaper that firmly fits within their budget, and they know that, but their preference still supersedes that, and then they overextend a little bit, whatever the case is. Obviously, just a random example, but I'm curious if that also gets layered into your decision cycle. It's not just the information gap, but like a known choice being made.
Hmm.
Yeah, I do it. It's funny, Eric. I was gonna actually bring up trading because trading is kind of like the Hall of Fame example for what can be perceived as irrational activity for how people invest. So
Just about
you actually
nothing is rational there.
yeah, I was gonna say, that you have way more application knowledge of that than I do. But yeah, we actually have a name for that whole study of that kind of overconsumption, and it's called marginal propensity of consumption. So economists, we measure if you give somebody $1, how much money do they spend? So in the United States, if you give somebody $1, they spend about $1.05, $1.10.
Hell yeah.
It's the cost of freedom.
In Germany, it's about 85 cents. America. So yeah, so we do account for that, and what we measure in economics, especially in the Austrian world, and to be honest, even in the microeconomic world, is the maximization of utility, the maximization
Mhm.
of happiness. So like somebody may overspend because they're getting marginally more utility, marginally more happiness from that overspend versus the accrued debt they're taking on.
Mhm.
So yeah, it's decisions. Like to me, like I hate debt. Um, but there's other people who have no problem, like, trading on margin, which blows my mind. But if that seems irrational to me, doesn't mean it's necessarily irrational to an individual actor.
Right. And not to follow too down in a rabbit hole, this stuff, honestly, it's just generally curious to me.
Well, keep going, dude. This is interesting.
Yeah. But to follow down kind of that same cycle of rational, is there any sort of way that you guys measure temporary irrationality and then kind of normalization post, like talking impulse purchases or something like that, or like how does stuff like that fit in?
Yeah, I forget. I think it was Greenspan. Irrational exuberance in the
Mm.
market. The dead cat bounce is
Ah,
irrational exuberance.
uh-huh.
Um, why are people buying? Actually, I was going to say why are people buying Credit Suisse right now, but that's probably wrong. But because I mean, there's more to that than just that. But
Yeah.
let me
You also got short sellers that got to close out. That adds buying pressure.
um, yeah, say that again. So I'll give you a better example that's probably less likely to hit people in the wallet is Cards Against Humanity. Every year after, so their biggest sale day is Black Friday. and they actually raise the price of Cards Against Humanity, and people buy it.
Huh.
And we really don't know how to explain that phenomenon. Some people just think it's worth the joke, and that's that may be where people are deriving utility. But we would call that almost like an inverse Giffen good in economics.
You don't think it has to do with the families being in town for Thanksgiving and not having anything to do with them?
That's true. So there was a God, I feel so bad because I can't remember who wrote it, but there was a paper written saying that the people who are buying Cards Against Humanity at that higher price are people who have no idea what it is and are just buying it as a Christmas gift. And so they're just logging online and buying it, not knowing, assuming that it's a lower price because it's Black Friday.
Ooh, does anybody else do that? Because that seems like a brilliant idea.
It does seem like a brilliant idea.
I might have to look that up real quick while you guys are talking.
Another kind of follow on that same path. How do you guys balance, I guess, like the concept of convenience falls into marginal utility? Does that sound right? Like, if you wanted to buy a product ABC and you already have 3 products in your Amazon cart, but it's slightly more expensive on whatever other in Amazon compared to another site. Does that kind of fall into that same marginal utility
so
bucket?
it kind of does. So part of marginal, so if you go, you go back one derivative on marginal utility to just like aggregate cost. We have this thing called shoe leather cost or transaction cost. So it's easier just to click that button and buy off Amazon than load up another website, buy the product, type everything in. So it's like that time exchange. And I just want to be clear. I can only really speak on Austrianism. Like I saw White Boy Rick's question asked like Keynesianism, neoclassicalism, new Keynesianism, and Kyle earlier on you said like what's the difference? It's like, well, Keynesianism is more of is macroeconomics. So before John Maynard Keynes, there was no macroeconomics. All right, that didn't exist. There was only microeconomics, and like which is at that point was almost like proto-utilitarianism.
What did Adam Smith do?
Yeah, so Adam Smith is saying this as somebody who read Wealth of Nations very young. So both Adam Smith and Karl Marx and Rousseau, they're philosophers, so they're not actual economists.
Gotcha.
Adam Smith more described a phenomenon. I am a true believer, and people can disagree with me on this, but I do think capitalism is a natural state. So Adam Smith really wrote about like describing what happens. Where like Karl Marx, ironically, who was sponsored by Friedrich Engels, whose father was a very, very wealthy industrialist. If you read Das Kapital, Das Kapital is a huge book, but I tell everybody to read it because you read it and be like, oh, this is why this doesn't work. You read it and be like, oh, this is clearly wrong. So those are kind of the philosophy of it, but actually how to analyze markets and understand, like really squeeze something out of it that's rational economics. Didn't really come about till John Maynard Keynes wrote his 2 treaties in the 1920s. So but yeah, new Keynesianism. It's so funny because I'm on the Keynesianism's capitalism. All right, there's this weird belief that Keynesianism's socialism. It's not. It's not socialism. Socialism is the government owns the means of production. Right. Keynesians don't believe that. Keynesians believe the government should have a large and impactful presence in the market, that they should drive markets, but they don't believe in public ownership of means of production. So I find myself defending Keynesians way more than anybody who's anti-Keynesian should ever defend them, because they'll call them socialists. I'm like, they're not socialists. They're capitalists just like we are. They just like more government in their soup. Don't confuse them with socialists.
Well, I mean, that's kind of the definition around here sometimes.
Yeah, all right. Yeah. So I'm just going to be biased this whole discussion on my worldview, so I don't want anybody to think I'm talking with like absolute authority on economics. Like, no, I'm just talking about my one really small worldview.
Right. Fair enough. Well, should we, now that we kind of touched a little bit on the trading, should we dive into like the main topic here that you wanted to bring up, Erik?
Yeah, why don't economics people, economists,
give me shit about my intro.
People that, yeah.
The amount of times I've been called economic person in my career in various speaking events makes me really, really nervous that I've been saying it wrong the entire time.
Actually, that brings me a quick question. This shouldn't take long. Is it economics or economics?
Okay, so it depends what side of the pond you're on. I say economics. My
I
British friends say economics.
I
Yeah, I
had a
barely speak English.
history
So.
teacher who did that too. It was an economics teacher, but he said it's the economy, so it's economics.
Okay,
So
that's
okay,
yeah,
well you can
that's
be Erik Mason then.
yeah, I know, right? That's really what we're doing. Like the
Yeah.
word photo. Look at the way the word photo is spelled. Like it's supposed to be like pahoto. If that's
Oh,
how
what
we're.
about comb and tomb and
Yeah,
any
right.
other? Yeah, why don't they rhyme?
Yeah, right.
Why don't they rhyme?
Sorry. Okay, let's
Uh,
get to the real question now.
As I was saying, why don't economics be? No, I'm just kidding. Why why don't why don't economists trade at large in your opinion? There's a handful of them that I know one of them that does actively trade, but he's not like active in economics anymore. He just kind of classifies himself as a macroeconomics dude, but I've always found it entertaining that most of the economics community that I know of, or the economic community, is not super into like actively trading. I have my hunches, but I'm curious from your perspective, why that's the case.
yeah, I think it's twofold. One, I think there's a lot of like, I always say, economics names itself the dismal science. All right, like, and we're the most pessimistic optimists you'll ever meet in the world. So like, I don't think I'm smarter than the market. All right, I don't think I can beat the market. Like, I've taken derivative courses. I have all those permissions turned on my trading account. I've certainly bought options. I know I love the math and the systems that exist around trading. That's why like Erik, like your channel, I find wicked interesting because it is interesting. I love seeing how the mentality of the people who play in the arena think. I think most economists are fascinated by you, Erik. I really do. I think the people in your world
Hmm.
are fascinating to us. But we view you guys the same way I go and watch a football game. Like, wow, that's cool. Yeah, I don't want to throw out my back. Because there's an acceptance that we don't think anybody can beat the market. A lot of economists think that.
But we know that it's possible. So I guess with that, is it just that you feel like it's not worth the effort?
Yeah,
But and I mean, you can even look beyond like retail traders, right? Like there's a lot of like hedge funds and stuff like that with really well audited, documented reports. Same thing if you look at like the US investing
Hmm.
championship, is that plenty of people beat the market.
And multiple times too.
and it just
Yeah. So
go finish. Sorry.
yeah, yeah. The reason why I've always found it so interesting is because to me, there's a lot of overlap between the two. And at least in the way that I go about creating wealth and maintaining wealth, I'm always looking to leverage efficiencies.
Yeah,
Like if I'm spending time on something and I can find other ways to make money on that same thing I'm spending the time on already, why wouldn't I do that?
Right.
So that's really the angle I'm approaching the question from.
yeah, and I mean, I don't want to dive too deep in this side of my personal life, but I have my cousin manages one of the largest large cap portfolios in the world. I certainly believe he beats the market. He does. He beats the market. He bought Whole Food just before Amazon bought it. I mean, he's on. If you turn on Bloomberg, you turn on MSNBC, you'll see him. He's brilliant. He's absolutely brilliant.
Mhm.
Yeah, I think he beats the market. But I think he's part of the market. Um, I think part of when you talk about maybe not day trading, but you talk about trying to beat the market in the long run. The strategies you take, if they're optimized strategies, are optimized in the long run. So, like, short run investment decisions always seem very weird to economists. We don't really. It's not that it's luck because you can have people like yourself, Erik, who work their absolute behind off and know how to make it around a corner before somebody else. I just don't think there's enough of people like you in the market to think it's a sustainable strategy. And as an economist, I therefore, if I'm not devoting all my time to watching your YouTube videos, following all the market, and doing all that, I know I'm going to lose because there's people like you out there who are going to take my lunch, and that's the way it should be. That, like, if you're the person putting in all the time, you're the person putting all the work in. Whether you're somebody doing it on your own, ripping apart data, or you're managing a $10 billion large cap portfolio, and you got an army of data nerds like me, you're going to win. You're going to win more than Erik sitting behind his computer. And as an economist, it tells me that that's no marginal gain for me. I'm better off throwing my money into an ETF. Has my personal investment portfolio outperformed the market? Yeah, okay, yeah, it has because I know a little bit more than the average bear, but it's outperformed it over the course of 10 years. I can't beat somebody day to day. I can't beat somebody year to year. I have to beat somebody because I bought a bunch of copper and silver, what do you call it, ETFs before that went through the roof. I'm somebody who saw that we were running out of helium is becoming a more scarce resource, and fiber optics are becoming more in demand, which use helium. So I looked for companies that build fiber optics, and I was like, okay, well, what's the biggest companies they use? And I found out the companies that use the helium, and I'm like, oh, I'm going to invest in those companies because like
But
I just know that.
that is actively
So you do
trading. Yeah.
trade. I
Yeah.
love it.
Yeah, but I would say I'm making that decision over the course of 5 years.
That doesn't matter. People trade on all sorts of different time frames. The fact that you're actively going in there and trying to manage a position or trimming something because economic headwinds have changed, like you're acting on information to try to do better than just buy and hold.
So this is interesting, and I'm going to flip it around to you two guys on this.
Hmm.
You consider that active trading. You consider a 10-year strategy where you're just sitting and holding because you know helium's becoming more scarce. Like that's active. You consider that active trading?
I would, if you're actively choosing a sector over another sector.
It's interesting. So any differential, differential from like the Russell 2000, you would consider diverse. You'd consider that like active versus passive investment.
It sounds more active to me
This is fascinating. I like this.
than what you made it sound like when you initially started your discussion there.
You can call it a rant.
And
That's perfectly fine.
yeah, Eric,
Erik,
you want to back me up on that, or you think I'm in the wrong?
I literally got disconnected
Oh
and
shit!
just in right as you said that. So
What did you?
I have no idea where we left off.
He was telling us about how he manages his portfolio, and then
Yep.
I was basically making the argument that anytime you're making actively managing your positions, doesn't matter the time frame, that's still actively trading, in my opinion.
Yeah.
Like you're using information to try to outperform the markets as a general.
I I have no dog in the fight. To me, it's potato, tomato, potato, whatever. Oh, because it's like I think typical terminology. We would say like trading is entering and exiting within a year, and investing is
Mhm.
greater than a year. But even that is, it's all bullshit. The way that I view it is like if somebody's actively expressing a thesis, then we're
Right.
we're either actively trading or actively investing, but it's certainly not passive. Which that's
Yes.
probably a
Yes. I think
better
that's
that's probably a better preamble way to ask the question. Passive versus active, investing versus trading. But yeah, I agree with the overall sentiment though that it's definitely based on what I was hearing before my internet decided to take a nap. It sounded more active than, but that sounds right. Like that sounds like
yeah.
exactly what I would expect to be occurring.
But whenever you ask people, like you never get that answer out of them. It's just no, I can't beat the market.
Yeah,
Well,
because
it sounds like you can. You just it's just a different time frame. The markets are fractal,
yeah,
right? Patterns repeat
yeah.
upon repeat upon a repeat.
No, I mean that's God, that's a good way to word it. I think that's really where I think you'd be hard pressed to find an economist who does that. Let me call it short term active trading.
Hmm. Hmm.
I just think it's the market. See, I'm a big believer that the only way you make money in the market in the short run is asymmetry in information. Not to jump back to what I said earlier,
I don't think that's true.
that you're either. Do you say you don't think it's true, or you think it's true?
No, not at all. Like if you look at really well documented phenomenon in derivatives markets like variance risk premiums, it's not asymmetry in information whatsoever. Like everybody has that information.
Oh,
Some of it is some of it is a matter of convenience. Some of it is a matter of sizing. Some of it is a matter of essentially balanced risk profiles. Like it's the same reason why we have like put skew on options. Obviously, I'm talking about a lot of option stuff because that's mostly where I spend my time. But yeah, I think I definitely wouldn't. I don't think one, from my opinion, I don't think that's the case. But more importantly, I don't even think like the broader documentation would support that, especially.
Well,
well, there's a difference
yeah, it's the
between
difference.
open information, the information sitting there, and people trading on that information. Those are two different things.
The
Just because
person's
exists out
understanding of the information.
Yes, just
Sorry,
because
yeah.
the information exists out there doesn't mean everybody's using that information to make decisions.
Mhm.
And when somebody information only becomes part of a decision once a decision's made. It's like every price exists in the market till it transacts.
Okay.
So just because information is publicly available, if all information was used all the time, I'd be out of a job. I'd be out of a job. It would be. I mean, like, but if I'm going in, like I can share the Excel file or the Google Doc. So I did this study because I'm a nerd. I love airplanes. I think airplanes are the coolest things in the world. And I think airplanes are great indicators of so many things in the market and in economies in general. So I analyzed using regression discontinuity design the impact on put call spreads after airplane crashes for Boeing over the last 35 airplane crashes. Okay, that's information that exists in the market, but how many people even know what RDD is?
I don't.
So can somebody trade on that information? It's information that exists, but is that information relative? I mean, I would be hard pressed to see if there's people actually trading Boeing stock on RDD.
Hmm.
So when we're talking about then of information asymmetry, you're bifurcating it not by whether or not it's available, but whether or not large numbers of people utilize it.
Yeah, so it's what's the dominant information standard in the market? Whatever the dominant information. So everything in economics is marginal. All right, we only measure marginal effects. So Erik, you work here behind off, and you're like, I understand this better. I looked up this data better than the average Joe who's just like me throwing money into an ETF or just doing a long hold strategy that's not as nimble. You deserve to win. Your people deserve to win on that because you're extracting more information. You're not the same as some guy just calling up his CFA and putting $5,000 in the market. And you guys as investors shouldn't be treated the same. You're different actors in the market.
Sure, that part makes sense, but I guess the part I go back to is like, going back to the study you just, talked about, right? Like if you study the last 35 crashes in Boeing and you know how put call ratios then react around a crash, like isn't that a short-term tradable event for you?
It is. And do you know what I did with that data? I watched the stock price over the next 6 months, saw that my conclusion was correct, and said, "Oh, that's interesting," and went back to investing in ETFs.
Can I have that paper?
I'll share it with you. Hold on,
No,
I
I'm just
definitely
kidding.
have it. Just because I was like, "Ooh, I wonder if my math is right."
Hmm.
I have it. I have it. I think I'm logged in here.
So do you think it's a matter of like you're not like super confident in the outcome and you would want to understand the outcome before placing any money at risk? Because to me, like if I had that same conviction or even the same hypothesis, I would speculate. And then I obviously would manage funds, but on yeah, exactly. On like little things like that, there is a life-changing amount of money that can be made.
Yeah, but I don't disagree with that at all. Like, I think one of the frustrating parts. I'm going to share this with you guys. I think one of the frustrating parts of you know, what I'm going to say is that that's not how we view it. We're nihilists to a certain point, where it's just the market's going to homogenize, and then what's the move after that? And see, that's where like people who think out the long, like a combination of a bunch of short-term strategies into one, like you said, life-defining sequence of transactions. That's a different beast. Like economists don't think that way. We view everything as these long, beautiful curves. We don't view anything as these like short-run events. There's currently there's currently a very big argument in economics right now, or it has been over the last 30 years. Is does long-run aggregate supply exist? And I know that sounds really nerdy. Um, does that exist? Does long run aggregate supply exist? Now that may sound stupid. What is Erik saying? He's talking about long run aggregate supply. What the hell is long run aggregate supply? Well, it has a different name.
Yeah, that was actually my question. Exactly.
It has another name, GDP. That's what long run aggregate supply is. There are economists who don't believe GDP exists.
Okay. Yeah.
Okay.
That long run aggregate supply doesn't exist, and that's based on actually a pretty important what do you call it, the LMIS model, which is like the basis of macroeconomic analysis. They think all GDP is a bunch of short-run aggregate supplies that are cobbled together to form long-run aggregate supply. They basically think there's 3 children in a trench coat trying to sneak into a movie, and that's GDP.
That's probably my favorite analogy I think I've ever heard.
That's a great visual.
Yeah.
I'm a giant fan of that.
So, um, Yeah, so like you could do all this analysis, and I just shared with you guys what my RDD analysis was for Boeing, and it's like, oh, that's great, that's cool. We don't even know if these long run principles are correct, so we're not going to act on short run data. We're just more trying to figure out if our model makes sense or not.
Hmm.
I love this because this, to me, it also like really bolsters a really common issue with traders and investors, and it's fascinating to hear it extend to kind of economists, at least in the way that you're sharing the thought process, where there's a really huge gap between theoretical and structural understanding and like the art of actually trading, right, and actually taking risk.
Yeah.
Mhm.
So it's fascinating to me to hear you kind of explain some of these concepts, because as a trader, like I literally based on the last like 5 things you said, there's like 5 tradable ideas, and I would be speculating on just about all of them.
So like this thing I shared with you guys, this BA analysis, this Boeing analysis, I built this for a because of a discussion I had with a fairly prominent YouTube day trader,
Okay.
because he kind of had a similar comment about like, hey, like how does this stuff work? Like, can you? He was fascinated by the field of econometrics, and that like you can nerd out this stuff because there's no different than what you guys are looking at. Or I mean, feel free to link it. It's for informational
Yeah.
purposes
Okay.
only, but to anybody on, just so they don't think we're talking about
Oh,
nonsense.
we have disclaimers. Don't worry.
You guys have great disclaimers. Would you want to take advice from a show called Financial Ineptitude? Is the best disclaimer I've ever heard in my life.
If you haven't heard by now, Manscaped now sells beard products. That's right, once again revolutionizing men's grooming with the brand new Beard Hedger Pro Kit. From a beard trim to a fresh shave, the technology behind the Beard Hedger Pro Kit allows you to shape your signature beard look. Now you can finally use Manscaped products to make your drapes match your carpet by going to manscaped.com and using code 2bulls for 20% off and free shipping. God damn, I was going to make that joke. Our friends over at Manscaped were kind enough to send me the Beard Hedger Pro Kit, and I gotta say, I was impressed with the quality and performance of the products. My thick, coarse beard hair has been giving me trouble with trimmers in the past, but the Beard Hedger was able to cut through the thicket without any tugging or discomfort at all. And because the trimmer has one rotary wheel with 20 length settings with only one guard, I don't have to worry about losing or breaking attachments anymore. So I've tamed my mane, and now you can too. No one likes a weird beard, so say goodbye to your stubble trouble with Manscaped's Pro Beard Kit. It all starts with that beard hedger that I mentioned. The thing's a juggernaut of fixing faces. Not only does it have the trimmer with the rotary wheel that gives you the 20 hair cutting lengths on just the one guard, it's also waterproof, so you can shave in the shower and avoid all the hair in the sink. The titanium coated T-blade is tough on hair but smooth on your face, leading to a single stroke efficiency that brings satisfaction one stroke at a time. Phrasing. The Pro Kit doesn't end there, though. They also created 4 dermatologist-tested formulations for your post-trim care. First is the beard shampoo and conditioner. Gotta remember that all your hair is different. Beard hair, as I mentioned, is more coarse and easier to damage than the hair on your head, if you have hair on your head. That's why the kit has made shampoo and conditioner specially designed to moisturize, reduce ingrown hairs, replace natural oils, and promote beard health. Next, the kit has Manscaped's Beard Oil, an essential piece for your main facial accessory. No one wants a guy whose beard is brittle and dry. The oil relieves dryness both on the beard and the skin beneath while adding a little shimmer and shine, which makes you look extra fine. Cap off the kit with the Beard Balm, a pomade that shapes, styles, moisturizes, and tames for a sculpted look to attract any fellows or dames. The Pro Beard Kit also comes with 3 free gifts: beard brush, comb, and scissors to ensure your beard is ready to impress. So get 20% off and free shipping with code 2bulls at manscaped.com. Of course, that's the number 2. That's 20% off with free shipping at manscaped.com using code 2bulls. Manscaped Beard Hedger, 1 stroke, 1 guard, 20 lengths.
But it's because like this is what hedge fund traders do. This is actually, I would argue that most hedge funds don't use RDD for some very nerdy mathematical reasons why they don't use it. But like he was like, wait a minute, like average Joe can access this? I'm like, yeah, our programming's free. Just Erik, just like you said, all this data is free and available. And if you just know how to manipulate it, you can see all these crazy trends. And that gentleman, good dude, what did he say to me? The same thing you said. Why aren't you trading on this?
Yeah.
And I was like, well, to quote John Maynard Keynes, because in the long run, we're all dead. Everything comes back to normal. Like,
It's such a nihilist approach.
it is.
No, it's so silly because yeah, in the long run, sure, but you know, as soon as you make that money, well, the short run looks real good.
Yeah, it's a lot more fun in the short run.
Yep.
economists would be more willing to day trade if it wasn't a good paying field. It's not the best paying field, but I definitely think we'd be if we were like making like minimum wage. I think it'd probably be more apt to do this.
Well, I think, and I mean, I think even the idea of relegating, an approach to like day trading in and of itself to me is super unappealing because to me that seems like a grind. It's actually funny to me because a couple times I know that you were doing it, being really kind, saying how hardworking I am, and it's if you
But it
talk to
is.
Kyle, it's kind of the
For
inverse.
you?
The way that I view it, the way that I view it is like you're absolutely right. And I look at the amount of time and I've spent easily probably 32 to 35,000 hours in total on like the skill set. But the at this point, it's like it's all maintenance, man. Like I know what I'm doing, I know what I'm looking for, I know how to find it. So a lot of what I do is actually like super fucking boring.
Mostly chess
And
videos.
yeah, dude, like exactly. I was actually joking with Kyle about that. He like introduced me to the world of online chess. So for like the last 2 or 3 weeks,
Hmm.
I literally am probably spending like 6 to 8 hours a day just fucking around with chess, realizing how stupid I am at that too. So it's like a never-ending list. But yeah, I feel like the the skill set once it's there is pretty well developed, and it's so fascinating to me, man, because it sounds like you're even the way that you're approaching the problem set is the way that I would approach the problem set. The difference is I would
Put
just
a little money on it.
speculate,
Yeah.
just a skosh.
Yeah, and
Yeah.
there's a difference between, long-term investing and day trading. There's a middle ground in there that's called swing trading where you
Yeah.
can, take positions for up to like 6 months at a time. Like there's
Is that fun
Yeah.
though? Like, do you enjoy doing that? Like,
Nah, dude,
I
like
mean, it depends on what time you have.
what
Really,
what
right?
I what I tell people is like trading is a business. Like trading is not
Yes.
for a hobbyist.
yeah.
And I do enjoy trading. Like I find it interesting, but the point of trading is to take the money I make and use that to enjoy. Like I was just telling Kyle, like bought a McLaren in cash like what 2 months ago. And
Hmm.
it's not because the McLaren people are just super nice and like Erik. It's because I hand them money and now I get to like realize some of the fruits of the labor. So to me, I very much approach trading um
As a
as
means to the
exactly like I
enjoyment.
am
Yeah.
exactly. I'm very intellectually curious by it, but I actually think that can be a bigger like problem than an asset because I think a lot of people run into big problems when they trade and they view it as a hobby. It's something that's fun, that's interesting because all these like subliminal, subconscious emotions creep into it, and now we have a fucked up approach. So I'm really careful to separate them. But yeah, it can
Yeah.
be. I mean, it's fascinating. You're already doing it.
I know. I know.
But you make money off that guy.
Well, sometimes, like I actually would also argue that trading, especially derivatives, isn't necessarily a zero sum game. Like each individual options contract, discrete of any other position, is in fact zero sum.
Yeah.
But when you look at the total of a portfolio, it's not zero sum. Like if you look at a covered call, for example, somebody sold a call against long shares and it rallies. They lose on that short call. They've won on the long shares. They've won on the overall position. And the other person won because of the short call that fell on the money. So it's like it's not exactly zero sum to that same degree once you kind of zoom out one click.
Okay, that makes more sense. That's the best description I've heard to argue against the zero sum.
I mean, like with me in there, there's a winner and a loser.
Again, sort of. If you look at the individual position of the short call, sure, there's a winner and a loser. But if you look in the broader context of that overall position, they both technically made money.
I think if you adjust for like the risk portfolio, somebody took on a lot because in economics we talk about risk. Risk is interest rates are functionality of risk, inflation, and desired rate of return.
Mhm.
So they lost against the marginal risk. They got even if they got a 2% return, the marginal risk they took on was say worth 8%. So they had a negative 6% return against the position. It's like how
I guess you could, yeah, I guess you could say that in a hypothetical standpoint, but I would just say the money in their pocket says otherwise.
yeah, and that is true. But it's again, it's like with economics, everything's a measure against the margin. Um, but there's been like it's an example of how the stock market isn't GDP.
Hmm.
Hmm.
Economies and stock markets aren't related at all. There's a lot of evidence showing that in some cases, even inversely related, they have a
Oh,
very weak p-value coefficient when it comes to causality.
this actually leads to like another like specific question I wanted to ask you. A lot of people talk about lead lag relationships, right? And I mean, it's like the perfect segue. So it sounds like you might not be a strong supporter of it, but I'm curious what your perspective is on just lead lag relationships. And for, well, you could probably explain it better than me, so I'm not going to dumb it down for everybody. You could probably do a better job than I can.
Yes, like
At dumbing it down.
Yeah, dude. Yeah. Well, obviously, there's a certain level.
Nice dig.
I already carry around like the dumbest level of information. So,
no, it's not that. I mean, all the best type of information uh, is used information. Like just
Mm.
knowing something is meaningless. Like I had one of
Oh, I see.
my mentor in economics always said, "Education for education's sake is a waste." Um, so
You just pissed off every college professor on planet Earth.
I teach in college too.
Every single anthropologist major is now just screaming at
Yelling at me. That's why, like, I make all my students like every time for the college class I teach, I make my students actually like use application because I want them to
That's
see that
awesome.
it's real.
Yeah, that's so
Yeah,
awesome.
yeah.
So like, you could like lead lag. There are lag effects. So one of like my first big research projects I did was on the asymmetric tax effects of firms of varying sizes. And what we looked at was we used the Roman-Romer nonlinear tax theory. So we basically said Roman-Romer with these two wicked famous economists, husband and wife pair, and they basically analyzed every time Congress did a tax change, how did it affect business? How did it affect like basically the revenues of corporations? So
Mhm.
I come from a small business family. I grew up pumping gas. So I was always fascinated, like, how does a tax cut that's unilateral, how does it affect like my dad's small business versus like AT&T or BOA or any of these huge firms? What basically found out is that using a bunch of kind of fun math and a lot of computing power and way too much free time, we basically figured out that firms are affected differently. So large firms, no matter how much you tax them, realistically never experience, unless you tax them at 99%, but let's say realistic tax rates, never really experience negative profits from taxation. That's because they can hire firms good enough, or they can hire accounting firms that are skilled enough to avoid the taxation. So we use a 36-month lag period. So we use 12 quarters to analyze that. Small businesses they get popped for a few quarters before they figure it out. So this idea of lag effect is real. Like I don't want to like dispute this idea that there's lag effects in the economy. I mean lag effects in the stock market. I do believe in that. But equities, the stock market makes up a very, very, very small portion of the overall economy.
Mm.
The like if you compare, like I trade, like I don't trade in that sense, but I deal a lot with public debt. I have a $1.2 billion debt portfolio. I've sold a $500 million bond for a pension obligation. So like I'm in the market every 3 months. I have a call with S&P tomorrow to get my rating, and you have all this. You have this information that flows into the market, but even the bond market is several times larger. The debt markets are several times larger than the equity markets.
Oh yeah.
And so, how much does the economy care about the stock market? Doesn't really, because the stock market's not
Right.
trading on real assets. You're not buying a piece of 3M. You're not buying a piece of GE. You're buying an underlying position related to GE. Like you're not giving $100 to GE unless GE is selling treasury stock it has. That money's not flowing to GE and then being used in R&D, which is
Right. That's all done after the IPO is
yeah.
done, right? Yeah.
So the economy, I know I think a lot of economists agree with this, but I'm sure some economists will light me up later on this, is that the economy really doesn't care about the stock market. The stock market's at the whims of the economy.
Right.
To be honest with you, I think public policy has a bigger impact on the stock market than the economy. I think whatever
Hmm.
Elizabeth Warren's, ranting about on any given Monday, I really should say that. I'm in Massachusetts.
How
But
how does she not know? How does she know so little?
right.
Every time I hear her talk about anything financial related, I'm like, what?
Well, I don't know why she's from Oklahoma and running in Massachusetts, but it's a different
That's
question. It's
another
another
good
good
question.
question I have in my life. But yeah, so is not to get like wicked off topic, but I'm just kind of like trying to build up why I think these lag effects aren't aren't the most material thing in an economist's mind. I think like to me, I'm a free market. I'm somebody who grew up in the United States. I'm a capitalist. I grew up in like I say, anybody who grew up in the Western world should believe this. But we believe in the solo growth model. That capital accumulation builds economies. That the more capital your economy absorbs, the more your economy builds relative to how much depreciates out. I don't know what that has to do with the stock market, and that's where economic growth is. So that's another reason, like economists don't like to trade, is because we have a view of the world that's kind of the antithesis of how a lot of short term, let's say less than 1 year trading occurs. Doesn't mean we're right, just means it's not our expertise.
Right.
Interesting.
That's interesting. That actually kind of maybe it leads in a little bit to one of we got to get to some of these Discord questions before we run out of time here. One of the questions that Robert and I were wondering was the CPI data, like the housing data. Like, why is there such a lag in that, like compared to actual market conditions? Like the information that they get for housing like seems to be like 6 to 12 months delayed.
Yeah. So a lot of times it's delayed on purpose, and they use they agglomerate the data, but that's because housing is so illiquid. Like
Mm-hmm.
it's such a long transactionary period. Like I mean, I don't know if you guys, if I'm sure you guys have bought houses where it's like, think of it, you
Oh
buy a
yeah.
house, you wait 6 months for the closing, or sorry, 60 days for the closing, then you close on it. But before you even put the offer on the house, you're already at the bank, locking an interest rate for a certain amount of money. Like, I do some investment property. Maybe it's a little different because you have some liquidity on hand to have shorter closing periods. But at the end of the day, you're talking months.
I was going to say you can close pretty quick with a cash deal.
Yeah.
Yeah.
We
Oh
sold,
yeah.
we sold a property right down the street from us, probably about 5 years ago. We closed in 14 days.
Yeah.
Some dude I was like, oh, I was like, okay. I mean, like, I'm cool with
Nice.
that. I guess you're cool with that. I guess we're fine. Let's go.
So then what's the reasoning for that? Like why would that like if the Fed is looking at CPI for guidance for whether or not they should raise or lower rates, and there's a number in there that's should be coming down, like how are they accounting for that lag?
So it's kind of, again, I'm going to sound like a broken record with the marginality. It's kind of like we don't look at the CPI. Like the CPI
Mm-hmm.
number doesn't matter to us. It's the change in the CPI. So if that trend is, so if your data is a year old and you're measuring it from today, but the previous data was a year old, that one,
It doesn't matter.
yeah, it doesn't. I would say it matters, but it's not as impactful. It's not like you're looking at data a year
Right.
ago. You're looking at a long horizon trend line. In
Mm-hmm.
CPI data, to be honest, and I play around with CPI data a lot. It's honestly pretty close. Not that surprises anybody reading this. It's pretty realistic, but also I'm gonna be a jerk right now. Inflation's localized. It's all local. There's
Mm,
national. Like, I hate when people talk about national inflation. I'm like, dude, I'm in
right.
Greater Boston. My inflation is different than the guy living in Jackson, Mississippi. Like, we don't have the same
Oh yeah.
inflation
Yeah.
profile.
Yeah.
Like,
Mm.
I'm sorry, we don't. Um, yeah. So yeah, it's delayed, but it's good broad enough data.
Okay. Oh, that makes sense. And I think that kind of, I think Robert won that argument then. Good job, Robert. He had one other follow up question to that with regards to CPI. Which has more influence on the OER, the housing costs or interest rates?
Ooh, that is a really, really good question. So, uh, okay, I'm gonna get a little. This may surprise you. I'm gonna get a little complicated on here.
Oh,
All right,
exciting.
CPI is a part of the interest rate in the economy. All right, so the market interest rate, we look at the Fisher equation, is your nominal interest rate equals your desired real rate of return plus inflation, which is represented as pi subscript e. So expected inflation. So the Fed puts out this data that's like the 5-year long run horizon inflation. It's at 3.16%. The Fed ideally wants it to be at 2%,
Hmm.
but it's at 3.16% right now. And what that basically says is that you should expect over the next 5 years that you should have an annual inflation rate of 3.16%, which we're way, way, way over.
Right.
But the change in CPI is expressed inflation. So if we take the nominal to interest rate and we say, okay, the Fisher equation, the nominal interest rate is your real rate of return plus expected inflation. So if you want 2% return and you're expecting inflation to be 3.1%, 3.16%, you should charge a nominal interest rate. Your coupon rate should be 5.16%. So it's not that they're completely different things. One dictates the other, but there's also a factor, which is real rate of return. This is why I hate the topic of negative interest rates. I sold short-term debt. I sold $100 million of short-term debt 2 years ago at 13.5 basis points. I borrowed $100 million for an entire year at 13.5 basis points. I was almost angry at that because I'm like, that's not real. That the economy is being manipulated. If I can get that interest rate,
Wow.
yeah. Could you imagine?
How did you get that much? Oh, this is for your Boston, I'm assuming, right?
Yeah,
Not
Quincy.
for,
Yeah,
like putting in a new home or a new addition to the bedroom. Or...
no. But like,
okay.
it was ridiculous. I was so scared of arbitrage because I mean, the money sweating in the corner would earn more interest than I'm paying on it. So
Right.
yeah, not to King Solomon. So I'm not trying to cut the baby in half, but they're one and the same. They're both equally important.
All right. I think you kind of answered Joel's question. Why do the economy and market act differently when they're both based on the purchasing and selling of goods and services?
Oh, I just
I think you
disagree with that.
demolished that a minute ago.
I wasn't trying to be mean there.
Basically saying
consumption's the largest portion of GDP, but it's not what drives your economy. It's capital accumulation that drives it.
Yeah.
I'm sorry, I didn't read that question before. That was very unprofessional.
No.
It was a good question too.
Joel will love it.
Can't wait to get like just spits on a piece of paper and mails it to me.
I know, right? What else you got for him, Erik?
One other question I had, and good emphasis there on the no. That's how I knew it was me. Is when the hard K came out as compared to the hard C in that scenario.
I know how to hit a K.
What would you do for Erik with the C? Would you do like Erik? Like
Eris? I just pronounce it as an S.
You can call it like my wife's from the South, so a lot of my in-laws, and when I go back down to West Virginia, it's Erik.
Like,
oh, yeah.
Okay.
I mean, couple less chromosomes, couple less vowels. You just
oh man, just isolating everybody today.
I was curious what your thoughts are. I feel like I have some of the answer already, but the bond market, do you track that at all, and specifically as it pertains to both economics and the markets? 'Cause to me, at least, it seems like it would inform both sides to some degree, but curious your thoughts.
Yeah, I monitor the bond market so close that I almost sometimes feel like I'm going insane.
There we go. Good.
So like obviously I deal a lot in the bond market. Just so far this year, I've sold about $275 million in public bonds. This year I'll probably close out close to $500 million by the time I'm done. I follow it very closely. So particularly with something I'm always interested in, and Erik, you may be familiar with this data series, and Kyle, I might have brought this up on a previous time I was on, is HQM, high quality market bonds. So the Federal Reserve, the Fred database, they carry this data for your high quality market bonds. Basically, those are any corporate bonds rated between A and AAA. I track that a lot because I pay those expenses. Like I pay when the market So here's the funny thing: I've been in meetings, fairly recent policy meetings, where people are surprised when they hear that wait a minute, our bonding rate went down, but the Fed raised rates, and I have to talk about like bond markets are so efficient nowadays that if they have already worked in that 25 basis point increase, they've already baked in that information. So when it settles, there's no that little tinge, that 10, 15 basis points of uncertainty if something crazy happened evaporates, and now you have a lower rate. What's crazier though is we do negotiated debt sales. So we don't do competitive bond sales anymore in the city. So I don't have competitive bond sales are just like you show up on a Tuesday, you're selling $100 million and 18 companies put in their offer blind, and then you rip them open at 12:15 in the afternoon, and the lowest guy wins. We start 2 weeks out from the date of sale negotiating. We are underwriters negotiating with large banks in order to figure out to get the best deal. So, I was doing a deal. This is all public record too, or all public access. I was doing a deal about maybe like a year ago, and I got a call from the Royal Bank of Canada, and we had a note that was coming due from. Or sorry, we were selling a bond, and they had a portion of the bond they wanted to buy that was due in 13 years, and they gave us a killer interest rate on it. Like they were like 75 basis below market, but we weren't allowed to call the bond. And I'm sitting there, I'm like, dude, rates are going up, man.
Huh.
Yeah, you want to give me 75 basis points? Yeah, hell yeah, I'll take that. So we monitor it a lot, and that's how we're able to make these more educated decisions. But it starts with that good macroeconomic data from Fred, and then working backwards to see how, if you're like Joe Biden being in office is really good for municipal bonds because they're tax free.
Oh, you were going to say
Public
comedy,
didn't-
but okay.
I stay away from the politics.
You're in politics.
No, I'm in the public sector. At least that's what I tell myself. That's what my
You don't
TED Talk
run
was
for
about.
office. Yeah.
No, I don't.
You just gotta make friends with the mayor.
But no, we when we have deficit spending, when we have, usually Democrats elected, that usually means higher taxes, which means there's a flight to tax-free financial vehicles. So we get to benefit from that.
I see.
Yeah.
So that's why you guys all vote blue.
So Massachusetts is the bluest state in the world. So I got Miss Liz in office.
Oh man, we keep going for hours, but it looks like Erik's got a hard stop here in the next couple minutes, so we should probably wrap things up here. Does anybody have anything else they'd like to leave listeners with before we wrap this thing up?
Actually, I just want to say thank you. I appreciate being on, and you guys let me ramble.
I was surprised we were able to talk about economics for the full hour. I thought for sure we'd have some history conversation in here somewhere.
We could do that later.
I think we might have to. All right, folks, that's going to take us to the end of this episode. I got to say thank you to everybody who stuck around to the end. Thanks to Erik and Erik for dropping by. If you'd like to hear more from either of the two guys here, we'll have all their links in the episode description, so you can check them out there. Check us out at twobullsinachinashop.com. Be back. We'll be back in a year soon with another exciting episode. But until then, stress that 5-star rating like it's a hard K and take care.
Oh my god, you guys are pissing. I love that. That was a blast.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
I'm going to leave this going for a little bit so we get a little bit of after hours. Erik, if you want to jump off, thanks for stopping by. We appreciate the questions and for carrying most of this discussion, because I think I was swimming in the deep end a little bit there by myself.
You guys are an absolute blast. Erik, I gotta say, that was one of the funnest conversations I had on a lot of this stuff, man. You get it. And sometimes talking to some people who are more active in trading, they don't get it. And it's a little fun to talk to somebody who knows their shit as well as you do.
Oh, I appreciate that, man. Yeah, this stuff's all like super fascinating to me. So it's a lot of it is just general interest. I think the parallel between economics and markets is super cool. And I always joke with Kyle, because I do talk about economics a lot, not obviously anywhere near the same level of efficacy that you do, but as it impacts like the trading world for me. So I think that that's a fun dialogue.
Yeah.
One of the things I hate about my field is we're such elitist pricks sometimes. Economics is for everybody, dude. It's like the I'm like a like I don't know if you saw my professional page. It's called the
Yeah.
Informal Economist, because like I hate the fact that we make economics out to be this like elitist field.
Mm.
All my great mentors in economics have been like, you got to democratize it, man. Economics isn't anything advanced. It's common sense in a language we don't understand. That's all economics is. There's nothing fancy to it. Yet we sit here, we're like, the marginal, blah, blah, blah. We talk about these massive fucking 30 syllable words that mean absolutely nothing. All right. We're a field that has named an entire study the shoe leather tax.
Oh God.
Like, like we're insane. And we try and act as if we're like the, this elitist group. We're not. It should be democratized.
Hang on, I'm writing that one down. I gotta look that up.
Yeah, I feel like honestly, some traders do the same thing too. But yeah, I think it's always a pleasure to talk with economists. I always get a kick out of it because part of the reason why I think traders can operate successfully is because we're fucking stupid and we don't know everything and we know we don't know everything. And that's kind of what unlocks the door for me to willingly take risk is my own ignorance to some degree. So yeah,
But I love that shit, dude. That's what's important. And like, it's not about not having enough information. It's you have the right amount of information. Like that's what it is.
right,
You
exactly.
have the right amount,
Exactly.
and you're making good
Yep.
actual decisions. This is why I'm an Austrian. I'm not an Austrian because I have this like moral belief and stuff like no, dude. I'm an Austrian because I just think the guy who's transacting, the dude who's making the trade, knows more about his personal economy and knows more about his risk profile and knows more about his willingness to engage in the market than I'll ever know. I don't give a crap how many degrees I have hanging on my wall. All right, that guy who's transacting, he's the economy, and I shouldn't sit in some ivory tower and be like, well, actually, he should have done this. Like that's bullshit. You can always make up the imaginary thing that could have happened, but the guy who's making the decision, that's the economy.